received a $200 dividend from ABC Co. We're receiving a dividend check. Now we're going to consider checks as cash. Now later on, if the check bounces, we'll have to deal with that. But hey, when we get paid a check, we're going to assume that it is cash. So on March 28th, we received a dividend check of $200. Now, why did we get that? We got it because we earned it through a good investment. So we're going to have to put that down in our revenues. This will be dividend income, $200, and that will flow up into our net income, and that'll increase our retained earnings, all through the closing process, which we'll talk about later, and our equity will go up. So as you can see, assets went up by $200. How did we finance that $200 of assets? We earned it, and we kept it in the business as owners. What are the accounts affected? We have more cash, $200 more. That would be a debit entry. And we have more dividend income. Now these dividends are not the same thing as dividends that we pay, which is something that reduces our retained earnings. This is something we're bringing in by making a good investment. So we have more dividend income. That's on the credit side of revenue, so we record that as a credit. And there you go. I hope you're getting the rhythm of how these work. So you want to know this expanded accounting equation and think through what you're giving up and what you're receiving. Or if you get an asset, how the asset was financed. That thinking will help you keep this pretty clear in your mind.